Well, U.S. natural gas prices are hovering near $3.22 on Friday, struggling to establish a clear direction as two opposing forces continue to offset each other. On one hand, robust LNG exports are providing solid support just above the $3.10 level. Export activity remains elevated, helping absorb domestic supply and preventing a deeper price correction. On the other hand, weather forecasts continue to trend warmer toward the end of February, pointing to lower heating demand and limiting upside potential. At the same time, production growth remains a key fundamental headwind. According to the latest outlook from the Energy Information Administration, marketed natural gas production is expected to rise by 2% to average 120.8 billion cubic feet per day in 2026, followed by another increase to a record 122.3 billion cubic feet per day in 2027. Most of this growth will come from three major producing regions: Appalachia in the northeast, the Permian Basin in western Texas and southeastern New Mexico, and the Haynesville in eastern Texas and Louisiana. The Permian leads the expansion, contributing 1.4 billion cubic feet per day of incremental supply in 2026 and another 0.6 billion cubic feet per day in 2027, largely driven by associated gas from oil production. The Haynesville is also projected to expand meaningfully, adding 1.2 billion cubic feet per day in 2026 and 1.6 billion cubic feet per day in 2027. Elevated price expectations, deeper well development economics, and proximity to Gulf Coast LNG terminals and industrial demand centers continue to attract drilling activity there. Meanwhile, looking at LNG shipping activity, total LNG carrying capacity departing U.S. ports reached 140 billion cubic feet last week, up 6 billion cubic feet from the previous week, with 37 vessels leaving port. However, despite rising export volumes, futures prices have continued to soften. This divergence suggests the market is focusing more on the approaching seasonal demand slowdown than on export strength. A similar pattern unfolded last year when cooler August temperatures pressured prices lower even as LNG exports expanded. This year, a comparable situation could develop around May or June. As new LNG capacity comes online and summer demand gradually builds, NYMEX prices may attempt to realign with the upward trend in LNG flows. From a technical perspective, the market continues to hold above the critical $3 level, which has repeatedly acted as strong support. The repeated defense of this zone reduces the immediate likelihood of a sustained breakdown. However, upside momentum remains fragile. Any sharp rally could quickly lose steam, especially as the market transitions toward the April contract and seasonal demand weakens. A decisive break below $3 would likely open the path toward the $2.80 area. For now, though, strong support continues to hold, making a breakdown less probable unless weather forecasts turn significantly warmer or production accelerates further. In the current environment, short-term buy-the-dip strategies may still work tactically. Longer-term bullish expectations, however, should remain measured given growing supply and seasonal headwinds. If you enjoy these market updates and want a bit more depth, I've launched channel memberships. Members get early access to new videos, so you can see the analysis before everyone else. If you find value in the content and want to support the work behind it, consider joining. Your support helps keep the channel going. Thanks for being here, see you in the next update.